The ticker flashes green across the financial terminals, holding firm around the $219 mark, anchoring a jaw-dropping $5.3 trillion market capitalization that commands the absolute center of gravity in global equity markets. To the casual retail investor scrolling through financial media headlines on their phone during a morning commute, Nvidia is viewed simply as the undisputed, high-flying monopolist of artificial intelligence chips, a juggernaut riding an unprecedented wave of software-driven hype. Turn on any mainstream financial network, and the consensus chatter is a monotonous loop. Questions about whether tech giants can sustain their capital expenditure, whether a cyclical peak is right around the corner, and whether a forward price-to-earnings ratio near 20 leaves any meat left on the bone. But this surface-level retail narrative completely misses the structural, physical reality of what is actually happening underneath the hood of modern server racks. Wall Street analysts staring at spreadsheets are largely blind to the terrifying physics bottlenecks governing the next generation of computing. They look at revenue multiples and gross margins hovering near historic highs while remaining entirely oblivious to the microscopic warfare playing out inside high-density data centers. The real constraint limiting human technological expansion isn't software logic. It is thermodynamics, electron transit times, and the brutal laws of electrical resistance. When data centers scale up to train multi-trillion parameter models, chips cannot operate in isolation. They are locked in a desperate race against latency and heat dissipation. A processor running at peak capacity generates thermal loads that would melt traditional silicon architecture in seconds, requiring radical breakthroughs in liquid cooling, complex multi-die packaging, and ultra-dense optical interconnects. Standard financial media treats these chips as discrete commodities, interchangeable widgets that can be swapped out for cheaper alternatives the moment a competitor undercuts the price. This is a profound misunderstanding of hardware-software co-design. What the market consistently misprices is that Nvidia has long ceased to be a mere silicon vendor. It is engineered a completely inescapable operational ecosystem, anchored by the CUDA software layer, transforming hardware into an integrated, self-reinforcing infrastructure utility. While retail traders panic over short-term macroeconomic jitters, treasury yield fluctuations, and headline-driven volatility, institutional heavyweights understand a fundamental truth. You cannot simply rewrite millions of lines of optimized, highly specialized deep learning code overnight to run on generic architecture. The switching costs are astronomically prohibitive, creating an economic moat so wide that standard valuation metrics fail to capture its true durability. Step into the daily trading volume and observe the invisible mechanics of market dynamics. Every time macro jitters trigger a knee-jerk media panic, whether it's a sudden spike in bond yields, a manufactured regulatory headline, or anxiety over quarterly capital expenditure pacing among hyperscalers, retail investors instinctively capitulate, locking in losses or trimming positions out of fear that the AI cycle has topped out. Beneath this surface chop, institutional heavyweights quietly absorb those shaken-out shares with surgical precision. Major asset managers, sovereign wealth funds, and quantitative desks utilize these localized pullbacks to execute massive accumulation programs. They aren't trading week-to-week price swings. They are positioning themselves around a multi-hundred-billion-dollar revenue machine backed by a visibility of orders stretching multiple years out into the future. Consider this. How are you personally navigating these high volatility tape environments? Are you sitting on the sidelines waiting for a deeper correction that the smart money keeps buying up? Or have you already built a core, long-term allocation in the backbone of global computing infrastructure? Drop your average cost basis and strategy in the comments below, because understanding how the institutional machinery interacts with retail emotion is the only way to avoid becoming liquidity for the big players. To truly grasp why this asset defies traditional cyclical framing, we have to look past the outdated historical narratives that still plague legacy financial analysis. For decades, Wall Street pigeonholed the company through the lens of cyclical consumer hardware, viewing it as a glorified graphics card vendor tethered to volatile PC gaming upgrade cycles, cryptocurrency mining crashes, and PC shipment volumes. Analysts love to model its revenue streams using historical semiconductor boom and bust templates, assuming that every supply shortage would inevitably be followed by a catastrophic inventory glut and margin collapse. That analogical framing is fundamentally broken. The modern business is anchored by the enterprise data center segment, which is scaled into a colossal engine generating tens of billions of dollars per quarter, fundamentally altering the company's financial profile. This isn't about selling discrete graphics chips to gamers playing on weekend afternoons. It is about deploying the computational core of the modern digital economy. The world's largest cloud providers, sovereign states, and enterprise conglomerates are no longer buying components to upgrade consumer PCs. They are constructing multi-billion-dollar AI factories. These facilities function as the foundational utilities of the 21st century, generating continuous recurring economic value by automating enterprise workflows, accelerating drug discovery, powering autonomous systems, and running complex simulation models across every major industry vertical. This evolution brings us directly to the multi-year growth catalysts, technological gatekeeper positioning, and complex risk vectors that will define the next phase of market evolution. The roadmap ahead is defined by relentless architectural leaps, transitioning from current powerhouses to advanced systems like the Rubin architecture, which drastically elevate performance per watt efficiency while driving down inference costs. Furthermore, the strategic orchestration of private capital and massive financing platforms, such as mobilizing hundreds of billions through partnerships with financial giants like BlackRock, Blackstone, Brookfield, and KKR to fund independent AI infrastructure, signals a brilliant structural shift. By actively helping to clear financing bottlenecks for data center operators, the company is systematically expanding its total addressable market, ensuring that capital availability never becomes the ceiling for hardware adoption. Of course, risks remain present and must be soberly evaluated. Customer concentration among a handful of hyperscale cloud titans, geopolitical friction and semiconductor export restrictions, and the constant execution pressure to maintain an insurmountable technological lead against aggressive in-house custom silicon initiatives by major cloud customers and traditional chip rivals. Yet, when you weigh these systemic challenges against a fortress balance sheet boasting immense free cash flow generation and a net cash position in the tens of billions, the structural thesis becomes clear. Short-term price noise, quarterly margin wobbles, and media-driven anxiety will always create localized turbulence, but for investors who zoom out and analyze the physics of global technological progress, looking past the immediate static is the single most important edge in modern markets. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.